Recent economic data out of the US seems fairly encouraging, although the upcoming US elections, the looming fiscal cliff and sluggish growth are still amongst the biggest uncertainties weighing on investors' minds. Joining me now to discuss the US economy and recent economic data is Joel Naroff, President and founder of Naroff Economic Advisors. First of all, Joel, with regards to two of the latest data releases, quite a substantial drop of 13.2% in durable goods orders in August, a much bigger decline than analysts were expecting, and also second quarter US GDP was revised down to 1.3%. What do you make of these figures?
Well, we never like to see these kinds of declines, especially in things such as durable goods orders, but we have to be a little careful in interpreting these numbers. First of all, the biggest decline was in civilian aircraft. Apparently, Boeing got no orders for sales in August, and that's really, really unusual. These are lumpy. They come and go in a random manner, and I wouldn't be surprised if we see, whether it's September or October or November, huge increases that make up for the decline in orders that we actually saw in August. So that's one thing to keep in mind. The second is that the other big decline came in the vehicle sector. That was after a large increase in the previous month. So once again, indicating that there's volatility there. Still, I'm a little concerned more about the vehicle sector because we had been seeing sales pick up, and if makers are becoming more cautious, that may be a sign that they are losing confidence in the economy going forward. And even when you take out the transportation sector, orders were down, and that tells me that the relatively weak growth we saw in the second quarter is going to continue. There's not a big difference between 1.3% and 1.7%. Both of them say the same thing. In the spring, the economy grew, but it was a really disappointing growth rate.
US consumer confidence jumped to a 7-month high, said to have been bolstered by a brighter outlook for overall business conditions and hiring. Now, the confidence index is something which has been fluctuating quite a lot so far this year. So do you really believe this higher level of confidence is sustainable, even with the looming fiscal cliff?
Well, I think what we have to ask is the question whether there's a difference between confidence on the household side and confidence on the business side. We're seeing all sorts of surveys that indicate that executives are really, really worried that Congress will drive the economy off the cliff at the end of this year. And as a result of that, they are protecting themselves. They're acting cautiously. They're not hiring people that they normally would hire. They're not investing. They're not placing orders. And we're seeing the result of that in a lot of the data that come out that reflect corporate decision-making. On the other hand, when we take a look at things such as retail sales, motor vehicle sales, housing sales, all the things that reflect confidence on the part of households, those are going up. And we see that reflected as well in the consumer confidence numbers. So there seems to be a real break between consumers who are spending more money and feeling a little bit better, and business leaders who are really worried that Congress will mess things up terribly at the end of the year, so they're protecting themselves against that possibility. And that seems to be the break we have right now in the economy.
Well, consumers also seem to be more upbeat about the employment outlook, yet unemployment has remained persistently above 8% for 43 straight months. And of course, the Fed remained driven to pumping more money into the economy until the jobless rate drops. Now, in just over a week's time, we get the release of September's change in non-farm payrolls and, of course, the unemployment rate. Are you as optimistic, or confident, I should say, in the employment outlook as the US consumers seem to be at present?
Well, there's a lot that goes into consumer confidence, especially about jobs. One of the things that I think workers are seeing is that the layoffs in their own businesses have really slowed down, if not stopped. So if you're not seeing coworkers lose their jobs, you stop being worried that you're going to lose their job. And as a result of that, your confidence in the labor market may go up, despite the fact that the unemployment rate's at 8% and there aren't a large number of jobs being created. And that's really part of what goes into consumer confidence. They don't necessarily look strictly at whether their business is hiring more people, but whether their business is laying off people. And if they're not doing it, they're less worried about their own job situation, and that raises their confidence. That doesn't mean they're confident about the labor market. And indeed, we're not seeing great job growth, in part because businesses are so concerned about the fiscal cliff. If they can put off hiring, they're going to do that until they know what Congress is going to do. As a result of that, I don't expect a great job report for September. I think it'll be better than the August one we had, but it's not going to be anything great, and we're not going to get lots of jobs being created until the uncertainty is removed.
If consumers do see the economy moving ahead, surely this is a good sign for President Barack Obama in his bid for re-election.
On the political side, obviously there are pros and cons on that, but I think much more importantly, if consumers are spending now and they're feeling better about things now, but businesses are cautious about the fiscal cliff, once we clear the beginning of the year, and if we see that Congress, even if it puts it off for 3 or 6 months, businesses will start hiring again, it tells me that there's every good reason to see a good pickup in the economy regardless of who is elected. There's pent-up need for workers because households are spending. It's not happening right now because of uncertainty. Once that uncertainty clears, businesses will hire and invest, and it doesn't matter whether it's Governor Romney or President Obama that gets reelected.
We finally seem to be seeing a more sustained and broad-based improvement in home prices, helped along by record low mortgage rates. Are we seeing an important turn here in the housing sector in terms of a housing recovery?
This is a process that's been going on really for about 18 months now. It's been slow, but it's been steady, and it really reflects the simple fact that when the housing bubble burst, it really crashed the entire sector. And when you have a massive injury, it takes time for that injury to heal. And I think after nearly 2 years of improvement, we're starting to see we've moved out of the negative side into the positive side, and with low mortgage rates that are going to go down if the Fed has its way, we may see that accelerate further. So I'm optimistic about it.
Joel, thank you very much for your comments on the US's road to recovery. I'm afraid that's all we have time for the moment, but please stay tuned to Dukascopy TV for more exclusive interviews. For the moment though, goodbye.